Okay, welcome to the deep dive. Today, we're pulling back the curtain on the investment operating system of Mohnish Pabrai.
Pabrai. Yeah, if you follow investing at all, you definitely know the name.
Absolutely. Indian-American investor, author of that great book, The Dhando Investor.
And really known for being, well, refreshingly open about shamelessly cloning investment giants like Buffett and Munger.
Right. And he's also a serious philanthropist, too, through the Dakshana Foundation.
Which is fantastic. But his results, investment-wise.
Yeah, they're pretty extraordinary. His Pabrai investment funds, they started back in 1999 with, what, a modest $1 million?
Just $1 million, and then compounded at just an incredible rate.
I mean, look at the numbers. From 2000 to 2017, the fund returned 1,103%.
1,100%. Compared to the S&P 500, like 122% over the same time.
Exactly. That's the kind of performance that, leads to an estimated net worth today of around $600 million.
Serious numbers.
So here's the central question we're kind of wrestling with in this deep dive. Value investing principles. Stuff like margin of safety, circle of confidence. They're widely known. They're everywhere.
Sure. Lots of people try to emulate Buffett and Munger. Read the same books. Follow the same principles.
Right. So what is it specifically, maybe less visible within Pabrai's approach, that lets him consistently find and act with real conviction on those incredible heads I win, tails I don't lose much opportunities?
Especially the ones that demand that profound patience, right? It's clearly got to be more than just reading the right stuff.
Yeah, the sources we've looked at really dig into this, and the core thesis seems to be it's not just that he's a diligent cloner or has a killer checklist.
No, it's this rare combination of things. It's a deep, almost unsettling level of psychological self-awareness, an incredible discipline in applying just a few very simple filters.
And, as you hinted, that extraordinary capacity for just inaction.
Weaponizing patience. I like that phrasing.
Exactly. He's essentially built a system that exploits predictable market biases, our aversion to complexity, our obsession with the short term.
It's this disciplined synthesis of philosophy, a clear process, and importantly, an engineered temperament that seems to be the real source code of his edge.
So our mission today is to unpack that specific operating system for you. We'll pull out the most important insights, see what makes it so powerful.
And just as important, understand where its limits might lie.
Okay, let's unpack this then.
So at the foundation of Pabrai's system, you've got these core pillars, almost like the operating code for his investing.
And the first one is his worldview. It's this really distinct, kind of unshakable lens he uses to view the market.
Yeah, he fundamentally sees markets as inefficient, irrational even, driven by primal forces like fear and greed.
He calls them auction-driven, which I think is a great way to put it. Prices aren't just set by some pure intrinsic value calculation.
No, they're set by human participants in this, sometimes frantic auction, and that naturally creates those gaps between price and value. That's where he hunts.
And his definition of risk is fascinating, too, because it's so specific. It's not just price volatility, like how much a stock bounces around day to day, right?
Absolutely not. He's crystal clear on this. Risk for him is the probability and the magnitude of permanent loss of capital. Full stop.
That's the bedrock. That's the whole heads I win, tails I don't lose much thing.
Exactly. And it's why he actively seeks out situations with low risk, high uncertainty.
Which sounds contradictory at first.
Right. High uncertainty terrifies most people, pushes prices down. But if the permanent downside is protected, maybe by valuation or hard assets, he sees that uncertainty as potentially creating a low risk entry point for a rational investor.
That is completely counterintuitive to how most people think about risk, isn't it?
Totally. And he roots this thinking in human nature.
Deeply, right. He draws massively from Charlie Munger's work on human misjudgment.
Yeah, he's convinced humans are just predictably prone to biases, herd behavior, overconfidence, even an aversion to copying good ideas, which is ironic given his cloning emphasis.
Yeah. So he expects markets to misprice assets because of these systematic human flaws.
Exactly. And his system is built precisely to take advantage of that predictability.
Okay, so that worldview, that expectation of inefficiency driven by human bias, that translates directly into these non-negotiable filters he uses.
The Dhando checklist, as it's often called. But the sources really emphasize it's not just having the list, it's the unwavering discipline in applying them together, conjunctively.
They sound incredibly strict, like gates he won't pass through unless everything lines up. What's the first one?
Filter 1. Simple, understandable businesses. Stay inside your circle of competence.
Meaning, if a business feels complex,
He argues it likely is, and complexity hides risk. He famously says if you're even wondering if something is in your circle, it's not. Just move on.
Simple as that. Okay, filter 2.
Establish businesses with moats and slow change. He loves companies with a long track record, proven durability, and those competitive advantages, the moats.
Like pricing power, brand strength, maybe regulatory barriers.
Exactly. And crucially, he prefers industries where technology isn't changing at lightning speed.
Yeah.
Slow change means more predictability for him.
Makes sense. Filter 3, this is the big one, right?
Yeah, significant discount to intrinsic value, the classic margin of safety straight out of Ben Graham.
So he's looking for assets trading way below what he thinks they're worth, like 50% off or more.
Often, yes. And he has this specific hunt for what he calls price to earnings, PE of 1 situations.
PE of 1? That seems almost impossible to find.
Or hidden PE of 1s, where the underlying economics, maybe after accounting for assets or future cash flows, make the current price look ridiculously cheap. It's an incredibly high bar.
Wow. Okay, filter 4 must be linked to that.
It is. Low risk, high uncertainty. That's the core. Heads I win, tails I don't lose much. Principle in filter form. Finding those asymmetric payoffs.
Where your maximum pain on the downside is really limited, but the potential gain is substantial if things work out.
Precisely. And finally, filter 5. Few, big, infrequent bets.
The Munger influence.
Pure Munger. He believes in waiting patiently, sometimes for years, for the absolute perfect pitch, and when he finds it, he bets heavily.
Which naturally leads to very infrequent trading.
Yeah.
Long holding periods.
Exactly. So yeah, individually, you look at these filters, simple business, moat, discount, route, they aren't necessarily groundbreaking ideas in value investing.
Right, you read about them everywhere.
But it's Pabrai's relentless discipline in applying them, particularly those brutally restrictive ones like the PE of 1 target or the too hard filter for complexity.
That's what dramatically narrows the universe of potential investments for him.
Right, and it forces that deep patience and that concentrated betting when he finally finds something that fits all the criteria.
It's the combination and the rigor that makes it unique. Which leads us to the third pillar you mentioned, his intellectual lineage, where he gets his ideas from.
Yeah, he calls it cloning, but it's really broad. He's not just cloning stock picks.
He's cloning frameworks and mindsets, right?
Absolutely. Obviously, Graham for margin of safety, and Buffett and Munger for, well, almost everything else. Moats, competence, temperament, concentration. He's incredibly upfront about just taking their best ideas.
That famous $650,100 lunch bid he won to have lunch with Buffett.
That wasn't just about getting stock tips. It was an act of profound respect for the source code, for the teachers.
But you could argue where he really adds a distinct layer, maybe differentiates himself a bit, is in his focus on psychology.
Oh, absolutely critical. Munger's psychology of human misjudgment is fundamental to Pabrai. She doesn't just read about cognitive biases.
He operates based on the assumption that other people will act irrationally because of them.
Exactly. Things like cloning aversion, the fact that people weirdly don't want to copy even brilliant proven ideas, reciprocation, fear, greed. He anticipates these.
He even uses psychological insights in managing his fund investors.
Reportedly, yeah. Sending physical gifts, for example, to tap into that reciprocation tendency. And he actively exploits others' aversion to cloning by, well, doing it shamelessly.
He even brings in evolutionary biology sometimes, doesn't he? To understand why these biases are so deeply wired.
Yes. Viewing the human brain as this sort of evolutionary mishmash helps explain why our market behavior is so often predictably irrational. It normalizes the craziness you sometimes see.
And the Dhando framework itself, that came from real-world observation, right? Watching the Patel community build their motel businesses.
Exactly right. That was his first big cloning success, you could say. He saw their low-risk, heads-I-win model for building businesses, and he codified it.
And didn't his own early business failure kind of hammer home that low-risk principle for him?
Viscerally, yes. He experienced firsthand the pain of violating it, of taking on too much risk. That lesson stuck.
And there's almost an implied philosophical layer there too, isn't there? Something about patience.
Totally. It resonates with ideas like Pascal's, that quote about humanity's problems stemming from man's inability to sit quietly in a room alone.
Right, the power of patience and inaction.
And the simple elegance of his filters echoes ideas from people like Einstein or Thoreau about simplicity being the ultimate sophistication. So, yeah, his cloning builds this multidisciplinary latticework of mental models, pulling wisdom from psychology, business, history, not just finance textbooks.
Okay, so that's the framework, the kind of engine under the hood. But how does this system actually perform when the market is throwing curveballs? How does it work under stress?
Yeah, this is where that temperament engine becomes so key. His patience, as we talked about, it isn't just some innate personality trait he was born with.
It's forced and engineered by his system.
Exactly. Waiting for those fat pitches,
Right.
requiring extremely restrictive valuations like PE of 1, it means he has to be patient. He often has no choice but to sit on his hands for long periods.
Like Munger says, you don't make money when you buy. You make money by waiting.
Precisely. His system is explicitly designed for long stretches of doing absolutely nothing.
And this enforced inaction, presumably, allows him to act countercyclically when everyone else is panicking or getting greedy.
That's the idea. During panics, when fear is rampant and assets are being dumped indiscriminately,
Suddenly his filters start lighting up with opportunities.
right. His low-risk, high-uncertainty framework lets him see potential where others only see dread. Think about 2008.
Right, the financial crisis.
He was initially fully invested, took a big hit, admitted he was caught very flat-footed, but then he recognized the panic itself had created tremendous opportunities.
So he deployed capital aggressively.
Yeah, in late 2008, especially into beaten-down commodities and a basket of small, cheap stocks that fit his criteria, and the result. His funds reportedly returned about 125% in 2009.
Wow, so he's willing to take the pain of paper losses.
As long as the underlying value is intact and there's no leverage forcing him to sell at the worst possible time.
Okay, and what about during manias? When greed is everywhere and prices are soaring.
His strict valuation and simple business criteria act as powerful brakes. He simply won't chase speculation. His too hard pile probably grows exponentially during bubbles.
Because nothing meets those strict discount requirements.
Exactly. The core focus remains on downside minimization. Heads I win, tails I don't lose much. That forces caution when things are euphoric and compels action when assets are dirt cheap but fundamentally sound. It cultivates that essential counter-sentiment behavior.
He even uses checklists, right? Like the ones Atul Gawande writes about for surgeons, as a final sanity check.
Yes, exactly. To dampen emotions, ensure he hasn't missed anything obvious in the final decision-making process. It just adds another objective layer to counter potential biases, especially when things feel heated.
Let's try and anchor this with a real example. The sources highlight his investment in Fiat Chrysler, FCAU. That feels like a classic Pabrai play.
It really does, a perfect illustration. He started building his position around 2012, I believe.
And the market hated auto companies then, right? Seen as a declining, lousy car business.
Exactly the kind of widespread pessimism where he hunts for mispricing. That's his fishing pond.
Okay, so how did FCAU fit his pillars? Let's run through the checklist. Worldview first.
Okay, worldview. Market pessimism created that crucial mispricing. That's the entry point.
Filters. Simple, understandable. Cars seem complex.
Well, he studied it deeply, the different brands, the management, the structure, until he felt he did understand the collection of assets he was buying. Established business? Yes, obviously, though struggling. Moat.
That's the tricky one for cars.
Right. It was less about the car business itself having a huge moat and more about trusting the leadership of Sergio Marchionne, the CEO.
The management angle.
Yeah, Marchionne had a proven track record of turning around difficult situations. Pabrai saw him as the catalyst to unlock the hidden value.
Okay, and the discount must have been significant.
Huge. When he was buying around $6 a share, the stock was trading at maybe a PE of 2 based on projected earnings, but he went deeper.
Some of the parts.
Exactly. He looked at the core Fiat business, plus valuable assets like Ferrari, which they were planning to spin off.
Right, that became a huge value driver.
And Jeep, Ram Trucks, Magneti Marelli. He estimated the Fiat stub alone was worth maybe $3.50, Ferrari maybe $2.50. Just those two parts basically equaled his purchase price.
Meaning he got Jeep, Ram, and the rest for essentially free.
That was the thesis. He saw a plausible path to the stock being worth $20, $30 eventually.
Wow. Okay, low risk, high uncertainty.
Absolutely. The low entry price at $6 provided that downside protection. Even if Marchionne failed completely, he argued, he still had the underlying asset value. If Marchionne succeeded, the upside was massive. Classic asymmetric payoff.
And big bet. He went in heavy.
It became a substantial position for the funds, reflecting that conviction after doing the work.
And connecting that back to his intellectual lineage.
It's classic Buffett monger, isn't it? Buying an undervalued asset with a capable manager in place to fix it or unlock value. And it required significant psychological fortitude, real guts, to invest heavily in a sector everyone else despised.
And the temperament engine. How did that play out?
Patience. Holding for years as Marchionne executed the complex restructuring plans. conviction to keep buying or holding despite all the negative sentiment, rational analysis of the assets and management overriding the emotional aversion to a lousy industry.
And the result, well, it speaks for itself.
Yeah, it was reportedly an 8-bagger for him, especially when you include the value of the Ferrari spin-off shares.
Just a perfect illustration of his system. Willingness to look at ugly ducklings, the importance of catalysts like management or spin-offs, and how he can pragmatically expand his circle of competence when the opportunity is truly compelling and fits that low-risk framework.
Yeah, but here's where it gets really interesting, when we look at what the system doesn't do.
Okay, so that's when the system works beautifully, finding value where others aren't looking. But what about the flip side? Let's talk about what we might call his anti-portfolio companies that really highlight the boundaries of his system.
And Tesla, TSLA, is maybe the classic example here.
Right. He was actually an early investor, which surprises some people.
Yeah, but he got out long before the massive surge in the stock price. And now, at its higher valuations, he puts it firmly in the too hard pile.
And his reasons for putting Tesla in the too hard pile now are a perfect demonstration of where his filters just don't apply.
Right, exactly. First, valuation. He'd look at the price relative to current cash flows, current earnings, and just say, this doesn't make any sense. It completely violates his deep discount and low PE criteria.
You know, PE of one there.
Mm-hmm.
And projecting the future cash flows.
Impossible from his perspective. He'd say, look, I cannot project the cash flows 5, 10, 15 years from now with any reasonable degree of certainty. It's too uncertain, too unpredictable.
Which violates his need for a somewhat predictable earnings trajectory, even if it's currently depressed.
Right. Straight into the too hard pile.
What about the reliance on Elon Musk? He's obviously pretty central to the whole Tesla story.
He acknowledges Musk is brilliant, even calls him not human sometimes in interviews, half-jokingly. But his system fundamentally avoids investment theses that solely hinge on one person's genius.
Especially without a massive margin of safety in the existing assets or cash flows.
Exactly. That's classic key man risk. And without a huge cushion, it's just not a heads I win, tails I don't lose much kind of bet for him.
So what does avoiding or, exiting early from something like Tesla tell us about the inherent trade-offs in his model?
Well, it starkly reveals its limitations when it comes to hyper-growth, narrative-driven tech companies. His system really struggles to value businesses based primarily on future potential, or intangible assets like software, brand built quickly, or disruption narratives that haven't fully played out yet in predictable cash flows.
It also really highlights the opportunity cost of having that too hard pile, doesn't it?
Absolutely. His system is phenomenal at helping him avoid major mistakes of, overpaying for hype or complexity he doesn't understand.
Which is huge for capital preservation.
Crucial. But the trade-off is it can lead to mistakes of omission, potentially missing out entirely on participation in truly transformative companies that just don't fit his very traditional value-centric metrics at any given price point.
So that preference for slow change industries while it reduces certain risks.
It also inherently risks sidestepping major wealth creation happening in rapidly evolving tech sectors.
Okay, so his system is clearly optimized for avoiding large losses over capturing every single possible spectacular gain. It's rational, it's been historically very successful for him, but it does have these inherent blind spots or opportunity costs in certain types of markets or companies.
Right. It's a specific tool for a specific job.
Now let's really put the system through its paces. Let's do a kind of red team challenge. Based on everything we've discussed, where is Pabrai's model most vulnerable or maybe brittle? Where might it struggle?
The sources seem to point to a few key areas. Prolonged momentum or growth-dominated markets seem like a major one.
Yeah, I can see that. If growth stocks, particularly in tech, just keep outperforming value stocks year after year.
His strict criteria mean he'll likely be sitting on the sidelines or holding positions that aren't keeping up. His patience gets severely tested, and he'll almost certainly underperform benchmarks that are heavily weighted towards those growth names.
What about markets where value creation is driven primarily by intangible assets? Things like software, data, network effects.
This feels like a core vulnerability. His framework is just so deeply rooted in valuing tangible assets or predictable, established cash flows from, understandable businesses.
Things you can almost touch and feel.
Right. Companies build mainly on brand power developed quickly, or data moats, or software platforms, or network effects. They're incredibly difficult to value using his traditional metrics. That simple business filter, which worked great for analyzing motels or manufacturing,
might screen out the next Google or Facebook entirely?
Potentially, yes. The Dhando model might just lack the appropriate tools for this newer paradigm of value creation.
and his preference for slow technological evolution. That seems like a double-edged sword.
It is. It's vulnerable when disruption happens rapidly, which seems increasingly common these days. What happens when a slow tech industry he's invested in suddenly gets blindsided by innovation?
The moat he thought was there disappears.
Exactly. His definition of a durable moat might fail. And by systematically avoiding fast tech to steer clear of speculative bubbles, he inherently risks missing out on fundamental secular growth trends.
Isn't there also the constant risk of value traps? Buying a business that looks cheap, but is actually an irreversible decline.
Definitely. His model relies heavily on the assumption that the business is temporarily distressed but fundamentally sound, or at least has hard asset value that provides a floor if the industry is dying or the company simply can't execute a turnaround.
That margin of safety can just evaporate. Poof.
Right. And what happens as his approach, especially the cloning and the Dhando framework, becomes more widely known and adopted? Does that edge get eroded over time?
Good question. If everyone's looking for the same thing.
Potentially, yeah. If more people are systematically hunting for PE of one stocks or cloning his public moves through 13F filings, those specific opportunities might become rarer or less mispriced.
So his psychological discipline is harder to replicate.
Much harder. But the pool of obvious public ideas that fit his very narrow criteria could certainly shrink, perhaps forcing him into less liquid or maybe more complex markets than he'd ideally prefer.
And finally, we touched on it, but that concentration risk. Making those few big bets is powerful when they work.
But if one goes really wrong, it significantly impacts overall results. Like that reported 30% loss on Horsehead Holding, that hurts when it's a large position.
So tails I don't lose much isn't an absolute guarantee of zero loss.
No, it's about minimizing the probability and magnitude of permanent loss. It's a probabilistic bet. But a big bet going bad can still cause significant damage to the portfolio.
Okay, so summing that up, the brittleness of his system seems to lie in its maybe rigidity when faced with investment opportunities driven by these newer value paradigms and intangibles, rapid tech disruption.
And its dependence on finding very specific types of inefficiencies that fit his narrow traditional criteria. His greatest strengths, that simplicity and discipline, while powerful, can actually become weaknesses if the market environment fundamentally shifts in terms of what creates long-term value.
To really see this play out, let's do a quick simulation. How would Mohnish Pabrai, using his strict framework as we understand it, analyze a modern, complex SaaS company like, say, Snowflake, S-N-O-W?
Okay, applying the Pabrai filter set to Snowflake. First step, shameless cloning check.
Do any of his trusted cloners own it or talk about it in a way he can easily understand and validate?
Probably not, or if they do, it's likely opaque based on metrics he doesn't use. So caution flag immediately goes up.
Okay, next, circle of competence. Is Snowflake simple and understandable for him?
Cloud data warehousing, complex consumption-based pricing models, specific tech architecture, intense competition from cloud giants like AWS, Google, Azure, his likely internal analysis.
Wow.
This is decidedly complicated.
Can he clearly understand the moat, if there even is one, in that competitive landscape?
If he's even hesitating or wondering about it, where does it go?
Straight into the too hard pile. Probably very early in the process.
Almost certainly. But just for the sake of argument, let's imagine he tried to force it through the Dhando filters. How would Snowflake fare?
Badly, I'm guessing. Establish slow change.
Nope. Snowflake is a relatively new public company in a hyper-competitive, rapidly evolving tech sector. Fails the slow rate of change requirement spectacularly.
Strong moat.
Very questionable from his perspective. Intense competition, rapid innovation, potential commoditization in cloud services. It casts serious doubt on whether there's a truly durable, wide moat in his definition.
Discount to value. PE of 1.
Not even close. Snowflake typically trades at extremely high revenue multiples, often without significant GAAP profit. A PE of 1 or even a 50% discount to some traditional intrinsic value calculation is just impossible. It exists in a completely different valuation universe than he operates in.
And low risk, high uncertainty. Tails I don't lose much.
High valuation plus high complexity equals high risk, high uncertainty. There's no plausible scenario where he could look at Snowflake at typical market prices and say, tails I don't lose much. The downside risk is substantial.
Okay, and predictability of future cash flows. Could he project them confidently 5, 10, 15 years out?
Absolutely not. The dynamic tech landscape, the evolving business model, the consumption-based revenue streams which can fluctuate, Predicting Snowflake's cash flows with the kind of confidence he requires is basically impossible. The answer would be a firm no.
So the simulation's conclusion seems pretty clear then.
Yeah, he would almost certainly pass on Snowflake at anything resembling its typical market valuations. It violates way too many of his core tenets. It's complex, it's in a rapidly changing sector, it trades at a high valuation, and its future cash flows are highly unpredictable. Straight to the too hard pile, no question.
And that, I think, perfectly illustrates both the power and the limitations of his system, doesn't it?
It really does. It's incredibly effective at finding these deep value opportunities that others miss, maybe due to fear or complexity aversion. But that same strength, the relentless focus on simplicity, slow change, and low traditional valuations, is also a significant barrier to participating in high-growth, intangible, heavy tech stories, unless their prices utterly collapse into his valuation framework.
It's a clear delineation of the specific asymmetric game he chooses to play, and plays very well.
Exactly.
So let's try and distill all of this down. We've covered a lot. What's the core takeaway, the essence of Mohnish Pabrai's system?
Okay, briefly, I'd say it's this disciplined simplicity, and it's driven by a worldview that just expects irrationality from the market. It applies those rigorous Dhando filters to find understandable, moated businesses trading at deep discounts. It's built on that foundation of intellectual cloning, especially Munger's psychology.
And it requires that engineered temperament, the patience, the ability to act counter-cyclically.
Right. That's the alchemy, the combination that allows him to exploit those asymmetric opportunities he finds.
But yeah, as we saw with Tesla and Snowflake, its rigidity makes it less effective in certain market environments. Tech, intangibles, momentum, and means it will inevitably miss certain types of growth stories.
It's a powerful but specialized system for a very specific investment game.
Okay, so if you could only take one single most powerful concept away from Mohnish Pabrai's approach, what would it be? What does this all mean for you, the listener?
For me, it has to be the relentless, almost obsessive application of that single principle. Heads I win, tails I don't lose much.
And why is that the most powerful lever, or why focus on that one?
Because it fundamentally flips the script on how you make investment decisions. It's not just about finding cheap stocks. It re-engineers your entire process to prioritize downside protection first.
Before you even think about the potential upside, you have to rigorously ask, what are all the ways I could permanently lose capital here? How could this go terribly wrong?
Exactly. It demands a robust pre-mortem analysis on every single potential investment.
It forces you to demand a significant margin of safety, not just in the price you pay, but in the underlying quality and resilience of the business itself.
Right. And it cultivates that deep patience needed to wait, sometimes for years, for opportunities where the risk-reward profile is truly genuinely asymmetric, where the downside is small and protected, but the upside is potentially significant.
And the simple math of compounding really backs this up, doesn't it?
Yeah.
Why is focusing on the downside so critical for long-term results?
Because avoiding the big losses is mathematically more important than hitting every single home run. Remember, a 50% loss requires a 100% gain just to get back to even.
That's a steep climb.
It's incredibly steep. Avoiding those catastrophic drawdowns is absolutely essential for long-term compounding success. So by obsessing over minimizing the tails I don't lose much part of the equation, the system ensures survival. It allows the winning bets, when they happen, to compound powerfully over time. It shifts investing away from trying to predict the future towards patiently exploiting situations where the odds are heavily, demonstrably in your favor.
That one principle, prioritizing downside protection above all else, that can truly transform your approach to risk, to capital allocation, and ultimately your path to long-term financial success, no matter what kind of investor you are.
Well said.
That was a fascinating deep dive into Mohnish Pabrai's investor operating system. It's really a powerful reminder, isn't it, of what can be achieved through disciplined simplicity.
And the psychological engineering required for that kind of patience.
And just the elegant asymmetric logic of that Dhando framework. Heads I win, tails I don't lose much.
Yeah, it shows that mastering a specific, well-defined approach and having the sheer discipline to stick to it, even when it means sitting on the sidelines for long periods, can be incredibly effective.
Even if it comes with those inherent boundaries and trade-offs we discussed.
Right. Know the game you're playing.
So the provocative thought we want to leave you with today is this. How might you take that core principle, that relentless focus on downside protection first, and apply it to your own investment decisions, even if you play a completely different investment game than Mohnish Pabrai does?
Something to chew on.